All right, guys, thanks for tuning in. My name is Ardi, and this is the second FLA Investment Division video. And due to y'all's request, this video is going to be about value and growth investing, which is personally my favorite type of investing. So let's jump right into it. All right, so what is value investing, or what is a value investor? So the true definition is you're basically buying stocks that are selling at a discount on the market due to either obscurity, out of the favor industry, or a low market cap. And then if you look at that graph right there, that'll give you some insight as well. So there's different methods to value investing. So the first one is the passive method, and that's actually led by Ben Graham, who we'll be talking about more in this video. And this is kind of where Warren Buffett drew his inspiration when he was starting off. If y'all have heard the story, whenever he picked up The Intelligent Investor, it was like a life-changing book to him, and I've actually got a copy right here. So definitely recommend this book. It's legendary. So yeah, that's the passive method, and that's basically using screening methods to determine undervalued securities. So one common theme you'll find through this presentation is we're really looking for something that's undervalued and that has value so that there's room for growth in the future. And then there's the contrarian method, and that's companies that are or will be doing poorly and you believe the market has overreacted. So I'll give you a quick example from one of my trades. Whenever Elon Musk was kind of getting into some trouble because of the podcast he had with Joe Rogan, and the stock fell like somewhere around 20%, that was just, in my opinion, the market overreacting. I still believe Tesla has value, and it didn't really change their cash flows or their inventory or anything. So I thought that was the market overreacting. So got some call options, and that was a very successful investment. So that's just kind of an example. And then activists. So that's actually going into the company and changing it, so, and fixing it. So that's a little bit harder to do as college students, but you can definitely work for a company that is basically an activist investor. So a good example of this is private equity. So in private equity companies, they will go in and sometimes they'll buy the whole thing, they'll do a leveraged buyout, and they will try their hardest to work with management, maybe get a new CEO, and really fix up the company so that it already has value, but they're going to create more. So those are the three different types of methods that we'll be covering in this presentation. So to start with passive, so that's looking for companies that are cheap without much reason to be cheap, if that makes sense. So it's developed largely by Ben Graham. Here's a picture of the book that I just showed you. So some screens to look for is a PE less than the inverse yield on the corporate AAA bonds, and then like the PE less than 40% average PE for the past 5 years, the dividend yields, the price to book, price to net current assets. So I'm not really going to go too in depth about these, but I will also be posting this presentation so you can go in and do some more research. But yeah, those are basically just some screens to look for. And just remember that this is passive value picking, not growth. So there is a difference. So the Buffett and then the growth plus value, we'll talk a little bit about that. So for business tenants, the company is and should be basically simple to understand. So if you're investing in a company, some type of crazy biopharmaceutical company that you don't even know what they do or how they make money, then that's probably not a good value investment for you. And Warren Buffett once said, if you can't explain it to an 8th grader, then you probably don't understand it. So that's kind of a good metric to basically live by. So yeah, so it should be simple and understand. That's where true value is generated. And then the firm should have consistent operating history, and that's basically stable and predictable. So, and then it should be favorable in long-term prospects. So a good way to really think about value investing is just kind of sitting down and thinking, okay, what are some companies in my everyday life that I deal with every day? Like, for example, Warren Buffett, his might have been a Coca-Cola or McDonald's or whatever, some company that you deal with in your day-to-day life. And then also is this company going to still be around in 10 years? If you really believe in that company and you think it's going to be around in 10 years, then that's possibly a good value investment with favorable long-term prospects. So for management, basically make sure the company has good management that you trust. And yeah, that's like basically the only way to put it. So if you trust this management, you trust the CEO, you believe that he's really invested into the company and he's the best CEO that they can have, and you think he's going to provide growth and be good for long term, then that's also one of the things you should look for in a value investment. Also, the companies should have high returns on equity. And then Buffett used a modified version of this that he called owner's earnings, and then you can see kind of the formula down there. And then it should also have high and stable profit margins. So just to give an example, you guys should all know profit margins. If you have high profit margins, then you're basically setting yourself up for success. Even if you don't sell as much as you predicted, just because of the sheer profit margins, you're probably going to be profitable. So yeah, use conservative estimates on earnings and then the discount rate, and then keep the view of Mr. Market. So I like to think of the market as kind of Mr. Market. He's very moody, all right? And then even valuable companies can be bought at attractive prices when investors turn away from them. So if there's a lot of fear in the market and investors are turning away from this company that they probably shouldn't be turning away from because it still has value. Even though there's just a lot of fear in the market, that doesn't mean that all companies have just lost value. So try to find a company that is undervalued, basically, like the point we mentioned earlier. So these are just going a little bit more in detail about the key metrics that I mentioned earlier. So the PE ratio, so how many dollars, that's basically just how many dollars you need to put in to get $1 out. So you want to have a lower PE ratio, obviously. You want to put less dollars in to get one out. So, but watch out for low earnings potential, tax costs, and high risk earnings. Also, you should be wary of how much debt a company is using. So if they're very profitable, but they're doing all this profit because they have a lot of debt and they're having a hard time paying the debt, watch out for that as well. And then price to book, also dividend yields. You want to look for high dividends. And one of my good friends, Wanyu, he's a value investor as well, and he likes to tell me that the eighth wonder of the world is compound interest. So watch out for those dividends. Debt to equity, free cash flows, and then the PEG ratio. So I'm not going to go too in depth about how these are calculated, but feel free to reach out to me and then do your own research as well. So cutting your risk. So that's the moat, all right? So the margin of safety. So your personal buffer against the risk. So yeah, you can kind of use like a benchmark. So let's say the S&P 500. That could be your benchmark. If you're looking to generate alpha and you're looking to make your investment do good relative to the S&P, then kind of have that margin of safety. Because I don't know if y'all have heard the bet that Warren Buffett made with a hedge fund a couple years back. He bet them that $1 million that they couldn't beat the S&P 500, and he was actually successful. So just think about it, like, and kind of sit back before you make an investment and just think, am I better off just investing in the S&P? So have that in mind as well. And then check the accounting, all right? So I like to look at facts. So 10Qs, financial statements, those are all facts, okay? There can be a lot of CEOs kind of talking up the company, but checking their accounting is really important. So all of your ratios are built upon the financials of the business, and also make sure the financials make sense as well. And also don't just trust the current earnings report, all right? So average earnings over time, adjusted earnings, and then, yeah, so EBITDA and CapEx, keep those in mind too. So now we're going to talk a little bit about activist value investing. So there's a price gap between the current and the potential value, and the way activist investors realize that value is by buying into a company and then being the catalyst that allows potential value to be attained. So basically, there's different types of activist investing. There's lone wolf, there's institutional investors, and then activity, hedge funds, and private equity companies like I mentioned earlier. So this is basically like you're taking it upon yourself or upon your institution or upon your team that you basically won't let this company fail. And hopefully it already has value. That's why you're involving yourself with it. But it's really going in there and kind of holding its hand along the process. Basically, that's activist investing. It's really interesting. And if you guys like finance and you want to work in a finance role, I would keep this in mind. You see a lot of like buy-side firms participating in activist investing. So yeah, I will be posting this presentation, so I'm not going to go too much over this slide, but this is a really good infographic that I found online, and yeah, it's really good. So now we're going to talk about the efficient market hypothesis. So it's the idea that self-driven nature of markets and the ready public information makes markets efficient, and the asset prices reflect their real given value, making it pointless to try and beat the market. So the case against that, not everyone views all available info. So not everyone is really checking.
Disagree with this wrong efficient market hypothesis. If everyone follow, if the market price is always correct, there are no undervalue. So
Exactly.
I disagree with this.
So if the market's always efficient, then basically everyone would be getting rich. You know what I mean? Yeah.
It's impossible.
That's a good point. So I've got my friend Wanyu here as well. So, and then not everyone reviews all available info. The info isn't processed the same way by everyone. So I might view an income statement, and then Wanyu might view the income statement, and we might get two completely like takeaways from it. So people's reactions to particular info is always different. So now we're going to talk about where can you maybe find value in today's day. So by the way, this is not investment advice. I'm not telling you guys to go purchase technology stocks or anything. I am just kind of relaying info. So I just want to put that out there, be safe. So the technology industry. So obviously in today's day, technology is somewhat taking over, and investing in a good technology company that has high value could be very profitable in today's day. So the 20th century, they saw a period of interrupted dominance by traditional corporations, but going into the late 90s, it was clear that this wasn't going to be the norm anymore. So you can see that by the way the market reacts. So in the early 2000s, we saw not really a crash, but kind of a correction and due to industry changes. So keep in mind where the industry is, and if, let's say, Amazon is going to take over a lot of companies, keep that in mind. Just kind of what's happening, the wave of the industry. So, and then the internet disrupted industries and quickly altered business models. So this is only accelerated, and now we're moving forward where technology is a core driver of new value. So that's personally where I think that you can find value in today's day. Also, a company that me and Wanyu really like is, for example, Blackstone. So if you know this company is like always paying their dividends on time, paying good dividends, a good value company, you can also find a more traditional company like that. So yeah, technology investing. So while value investors have focused on financial analysis to identify underpricing in securities, focusing on new technology where others are not seeing the implication of this is a new form of arbitrage, all right? So technology companies, especially small tech stocks, can be more volatile and create better opportunities for investors. So that's kind of self-explanatory. So key technologies that are expected to create multiple trillions in the market cap over the next decades are some of these on the right. So blockchain infrastructure, AI, energy storage, robotics and industry, and then genome sequencing. So keep in mind, like wow, I think this is an awesome technology, and it's going to have a lot of disruptions on the market. Keep that in mind, and then kind of ride that wave. So famous value and growth investors, obviously my favorite, Warren Buffett from Berkshire Hathaway, and then Seth, Bill Ackman from Pershing Square, the hedge fund manager, and then these are just kind of some statistics about them. So I'll give a quote by Seth. So risk is a perception of the probability of loss and the potential magnitude of loss. So always have risk in mind, all right? So yeah, and those are also some of their Sharpe ratios that are really interesting. And then if you want to learn more about Warren Buffett and his approach to value investing, you can always listen to or read his letter to the shareholders. So this happens annually, I believe, right?
It's annually
Yeah.
in May.
Me and Wanyu might actually go this May to the Berkshire Hathaway shareholder meeting and sit through that. So it'll be very interesting. So we always encourage you guys to do your own research and just basically learn as much as you can. And the beautiful thing about value investing is, you're not really sitting behind and looking at these crazy charts trying to predict, okay, now should be the entry based on a Bollinger line. You're really just, I don't even know how many times Warren Buffett looks at a computer. Probably not very.
He don't have computer in his office.
Probably not very often. All right, so you're sitting there and you're really thinking like, all right, what's a good company that I think is going to be around for the next 10 years? What are some ratios that I think it should fit in, and some criteria that I think it should fit inside? And once you formulate your own like individual investment philosophy on what you personally think value investing is, that's when I think you guys are going to start seeing like exponential returns and just like when I met Wanyu, he taught me a lot about value investing and told me to read The Intelligent Investor, and it really changed the way I think about investing. And like once again, like that's why I think it's the true form of investing. So just before we end it, I'm going to read y'all a quote directly from The Intelligent Investor. Okay, so this is the preface to the 4th edition by Warren E. Buffett. As you can see, this is the same cover I had posted in the slide. Definitely would recommend buying this book for anyone. Okay, so to invest successfully over a lifetime does not require a stratospheric IQ, unusual business insights, or insider information. What's needed is sound intellectual framework for making decisions and the ability to keep emotions from corroding that framework. So this book precisely and clearly prescribes the proper framework you must supply in the emotional discipline. So he also gives a quote and says, your biggest enemy sometimes can be yourself because of the emotions. So you really have to learn how to harness those. And like I mentioned earlier, once you create that investment philosophy and that criteria, it's going to help you kind of control the inner beast and control like, oh man, I just made this trade, it went down today. I don't think I should hold it anymore. I should sell it. If you're really a disciplined value investor, you're gonna have those days where it's like, oh, my investment, didn't do as well today. But if it's a true value investment, then you're not really worried, because hopefully you're gonna be in this long term for maybe more than 6 to 10 years. So yeah, great book. He also gives a really good story about one of the smartest men, Sir Isaac Newton, and his investment in the South Sea Shores Company, and how he kind of gave in to the market's fear. And the smartest man that we know, one of the best scientists, actually made, some would say, a foolish investment decision because he couldn't learn how to control his discipline, and he hadn't really formulated a really solid investment philosophy. So I really want to thank you guys for listening, and here's mine and Yayati's email address. If you have any questions, feel free to call us or email us. I'm always available to meet with you guys. I am going to be posting this to the FLA group chat. So yeah, thanks again for listening, and I really appreciate your time. Hopefully you learned a little bit something over this second presentation. See you guys on the next one.
Do I need to take? Oh, hi, my name is Wanyu Chen. I'm a value investor and also a millionaire. I purchased my first stock when I was 10, and 8 years gave me 10 times return from the original. Why I prefer value investing? Because I believe the truth and the real principle can change by time. And most of the famous investors like Warren Buffett, Peter Lynch, they are value investors. And if I use one sentence to conclude value investing, is purchase all the asset in a discount price. For example, purchase a stock. If its real value is $1, you use 40 cents to purchase it. And you do not need to know what's the value is the real value right now. Because for instance, if you see a people who is like with a white hairs, You don't know what the exact his age is, but you know he's very old. So in the stock market, it's the same. You know, find the stock, and you do not need to know what the exact value is, but you know it's undervalued. Find a company like this and invest in it and keep it